Hi there, my name is Kent Skornia, President and CEO of Krilogy. I'm here with my partner and Chief Investment Officer, John McArthur. And this is your July market perspective update. John, good to be with you again.
Nice to be here.
And here we are in a month. A month flies by pretty quick, doesn't it?
A good month too, for the market anyway. So
up 9, right?
We'll take it.
We'll take it. We'll take it. Well, let's see. Interest rates, inflation, recession, earnings, valuation. What's your thoughts? What are you guys thinking about right now?
Those are certainly the key headline issues for the market. You know, the old expression "Don't fight the Fed," I feel like is dominating right now. If we look at the past couple years, the market, went well above trend to the upside, really driven by policy, monetary policy, fiscal policy. And of course, the pendulum is swinging in the other direction now. The Fed is in tightening mode for appropriate reasons with inflation. CPI year over year in June was 9%, north of 9%. So, I think
for a lot of investors, unprecedented in their investing career,
without question.
Yeah.
And it's front and center for the Fed. And I think the market was absolutely due for an oversold move like we've seen. I think the market's 12.5% or so off the bottom from what we saw mid-June at about 36 on the S&P to 4,100 roughly right now. So not surprising. We've got very oversold. Pessimism had hit extreme levels. So very consistent, unfortunately, in bear markets,
right.
And that is how we are categorized still for the moment. And I think the market, as we look at especially the last week or so, if we go back to the Fed last week, the market really anchored on the hint of the Fed maybe being done or very close to done with rates. And Chairman Powell talked about a 2.5%-ish neutral rate. And frankly, that feels aggressive. And I think some of the Fed governors have come out since then to try to squash that conversation. And if you think about it, we've got very high CPI prints, inflation prints, extremely high unemployment at 3.6%.
Consumer still seems to be strong.
Consumer is still spending.
Yeah.
So it's definitely we definitely have a ways to go, I think, for the Fed to really dampen demand in order to align more closely with supply, which is their objective.
And an investor and I had a conversation the other day, and they said, well, what can you sort of guarantee through this moment? I said, volatility. Yeah. It's about the only thing we can talk about where we know it's just going to be choppy here for quite some time. Yeah. Valuations and earnings. Talk to us about that.
Yeah, I think that's right. The volatility expectation is correct. Ultimately, all else equal, stock prices are going to follow earnings over time. Of course, that doesn't exist in a vacuum. So really policy continues to drive the day. I mean, if we step back and recognize that by the end of this year, the Fed will have risen the Fed funds rate roughly 300 basis points.
Huge move.
Is historic in 6 months. Right. So it's historic on all accounts, and that has to show up in the economy. And we're starting to see signs, and we have begun to see signs over the last few weeks or even months that demand is stalling a little bit, that inflation is rolling over. We're seeing it in some commodities. One of the most encouraging signs on the inflation front that I saw yesterday, in fact, was the ISM Prices Paid Index, which is the reason why that's important is it closely aligns with CPI. So it rolled over to levels we haven't seen since August of 2020. And so that's really encouraging because it's if history is any guide, CPI should follow. And that needs to happen.
It absolutely must happen for this economy to turn in the right direction.
The Fed cannot fall short.
Yeah.
We are just so extended beyond their target rate of 2%. We've got a long way to go. So really the magnitude and that trajectory is really important. And that likely is going to take some time. Hopefully When July numbers come out, we see some meaningful progress, which would hopefully help support some of the market's move. But, if we get back to your question on earnings, I think as we look at 2023, the S&P a couple months ago was expecting earnings around $250. As we've worked our way through earnings season, which have been much better than feared, we're maybe 235 to 240. So forward earnings are coming down a little bit, expectations. And if we want to start to apply some numbers and price to earnings multiple, if we take the current level 4,100 on the S&P over 240, we're looking still at a 17 times PE, which is still, it's historically average, but in a contractionary environment may not be enough. And with these type of rate cuts that we're seeing, it's reasonable to assume that we are early stages of earnings revisions downward.
Yeah.
In fairness, the market tends to bottom 50% of the way through that. So the market always bottoms, whether we're talking about economic data or earnings revisions downward, it always bottoms before the bottom of
way
the data.
Ahead of the actual data, correct.
It's historically done that, but we're arguably in early innings of that, given the magnitude of the rate hikes and the quick ascent in rate hikes. So, if we start to, if we look at, the earnings, the average recession, by the way, earnings declines 26%. So if we start to apply some numbers there and take half of that, so if we take $218 in earnings for the S&P in 2023, and a 3,500 level on the S&P, now we're looking at price to earnings ratios of 16. So it's not that distinct. It's reasonable, and it's not that different from levels we're at currently. So, we can get cute and start to kind of play with the numbers, but prices obviously come down quite a bit. Is it the ultimate level that we will ultimately see? I'm not sure. I know these processes tend to take time. Bear markets tend to last 12, 14 months. We're 6 months of the way in. So it's likely going to take time.
Speaking of cute and getting cute with the numbers and data, right? Are we in a recession is the question, right? 2 consecutive quarters of GDP contraction. The National Bureau of Economic Research is the official organization that declares a recession.
Right.
But they won't do that for quite some time.
Right. That's right. They'll always announce after the fact.
Way after the fact.
They will. And I think even though we have had 2 negative quarters, they will say that's a general rule of thumb from a recession perspective. I think if you peek under the hood, 4 of their major indicators are not showing negative growth.
Right.
And so I think when you look at the mosaic of economic data, if you will, I think we realize, especially unemployment and so forth, I think we see that, yes, softening is occurring, but official recession at the moment is unlikely. Now, evidence is increasingly picking up that we're heading in that direction. The yield curve inversion, I think the financial media likes to often talk about the 2-year Treasury yield related to the 10-year Treasury yield. Again, general rule of thumb, but not the end-all be-all. If we take a composite of yield curves and look at the inversion percentage of that composite, they're approaching the 50% level, which has been historically much more accurate. And so we're getting to those. Yep. We're getting to those moments. In fact, the 3-month Treasury bill relative to the 10-year is really close, trending in that direction. Now, again, though, from a market perspective, the market historically has continued to run once those moments occur. So it's really tricky in terms of trying to call tops and bottoms, and certainly navigate around that.
And that brings us now to portfolio management, right? Yep. What are you, it's been a month since we talked about, last time we sat down here, the market had a really, really difficult month.
Did.
Now we're sitting here after July, a nice little bounce back.
Yes.
What are you having a conversation with your clients about?
I think it's important to remember not to abort your plan. If you have a sensible, well thought out portfolio construction, stick to it. Again, to throw out a few statistics, if we go back to 1982, any period where we have a bear market and not a recession, and the market's down less than 30%, the recovery time is 4 months.
Yeah.
So the bounce back ability is really sharp. We're getting a sample of that now. We've had a 12.5% move in a couple of weeks. So stick to the plan. Knee-jerk reactions are rarely successful from a portfolio strategy perspective. It is, however, a good time to look at tax loss harvesting opportunities. If you got caught up in some of the unprofitable growth names, some of those types of positions that maybe don't align with your long-term plan. We talked about dividends in our last video, the importance of dividends on a go forward.
Yep.
We've lost sight of that really since QE began in 2010 and has now, ended. I think that makes sense going forward. I think also from broad diversification perspective, international and emerging markets have been unloved for this whole cycle.
Yeah.
U.S. has handily outperformed since 2009. Those dispersions are very, very wide.
Right.
And to the extent that we get a weaker U.S. dollar on a multi-year basis, that's a catalyst for international investing. And you'll often find strong dividend payers internationally. So
there's also a segment of the market that we really don't talk too much about, but it's the alternative space.
Yep.
In your portfolio, which, as the market was on this nice long bull run, the alts weren't that attractive until they are, right?
Yeah.
And there are certain parts of the alt space that are
It's a
very
great point.
attractive.
They're often characterized by low or non-correlation to the stock and bond market. Their target returns are often at mid-single digits to upper single digits, which, let's be honest, relative to the stock market, the last 10 years, that's second fiddle.
Not good enough.
It's not good enough, but
They held up in the first quarter of this year.
The first half of this year, they've been an absolute blessing. I think, if we look at the composite of alternatives, we're anywhere from up a couple percent to even mid-single digits to the positive in an environment where bonds were down 10 to 12% at one point. They've recovered a little bit since then. In the stock
worst
market,
bond market in 50 years.
That's right.
Yeah,
that's exactly. So
really difficult.
That consideration, the trade-offs between less liquidity can be a sensible conversation with your advisor at some point as well.
And you have to do deep due diligence on the alts before you decide to get into them. So
they're not all created equal. We spend 15 to 18 months on average before approving the ones that we've approved, which is a short list anyway.
So now we're heading into August, last part of the year. What are you expecting? Any sort of portfolio adjustments you guys are looking to make at the moment?
It's a great question. We made a fixed income change, which has worked out well so far. Again, it's a month, but in the middle of June, the 10-year Treasury hit 3.5%. So at that moment, we were a buyer of bonds. We're increasing duration and quality in the portfolio within fixed income. Frankly, we're ready and positioned to add to equity in many of our models. We're not ready to do that yet.
Yeah.
We've got our Qs, which are both fundamental and technical analysis oriented, and if that opportunity comes, we'll be prepared to do that. We're not seeing those conditions yet. It frankly requires lower lows than what we've seen. Which again, if interest rates truly continue to take hold and inflation doesn't roll over strong enough, and the Fed has to keep their foot on the gas longer, then that day may come.
Yeah.
And we'll be ready if and when it does.
Love it. Well, thank you, John, for your time and appreciate your insight.
My pleasure.
As always, we appreciate you, our clients, just allowing us to be stewards of your wealth and helping you and your families achieve your financial goals. So for John McArthur, myself, Kent Skornia, here at Krilogy, thank you very much. Have a great day.
Thank you.